Hello, I am Nande Boss, Communications Manager at Grey Swan. Today, I have the honor and privilege of talking to Niels Jensen, Chief Investment Officer at Absolute Return Partners in the United Kingdom. Niels has over 30 years investment banking and investment management experience, loves what he does, and when I thought of a guest to invite to give commentary on the significant inauguration of President Joe Biden in America, he definitely came to mind. So Niels has titled his presentation, The Beginning of an Era. So enjoy as you watch this. Know this will be valuable to us. Welcome, Niels, and over to you.
Thank you, Nanda. And just for all of you who listen to me now, you should be aware that this is Nanda's very, very polite way of saying that I'm an old fart. But that's just the way it is. I had to live with that. Let me go through, if I flip quickly to page 3 of my presentation. It seems to be the almost like the standard in the financial industry that Republicans are always better for financial markets than Democrats are. But as you can see here on slide 3, the fact is actually quite different. When the Democrats have swept both chambers of Congress plus the Oval Office, they have done far better than the Republicans have when they have swept all three of these institutions. So saying that the Democratic victory is bad for the stock market in the US is not necessarily true. Let's quickly flip to page 4 and look at Biden's spending plans for the next couple of years. Biden has made very clear and very quickly clear that he intends to spend big. Biden's plan at the moment stands at about $1.9 trillion. For those of you who don't know how big the US economy is, that is almost exactly 10% of GDP. So we're talking about a significant spending program that is about to go into action. And as you can see on this slide, this puts the US economy in the lead in terms of fiscal support coming out of the COVID crisis as a percent of total GDP. For those of you who have traveled in the US, you will be painfully aware that the US desperately needs some spending. The US infrastructure is not exactly in good shape. The US electricity infrastructure is in particularly bad shape. And as you can see on this slide, the US electricity supply, reliability, and quality is at par with emerging market countries and not exactly at par with the most sophisticated countries in the world or the most advanced countries in the world. Biden's stimulus program will definitely turbocharge the US economy in 2021. It will bring, as I said, it will add a significant percentage to economic growth if he ends up spending 10% of GDP in public spending, and it will bring the economy back to full employment by the fourth quarter of 2022. So assuming that we don't hit any bumps in the road with respect to the vaccine program, the US economy should be pretty much back on track by late next year. That was all I want to say about public spending, but in the private sector, there's also a considerable amount of money to be spent over the next months and quarters. In the private sector, total deposit and cash held by US households and corporates are up $3 trillion over the last 12 months. That's equivalent to 15% of GDP. And that's a massive war chest that could end up being spent when the economy comes back to normal over the next few quarters. That's the combination of public spending, significant public spending, and more than significant private sector spending could lead to a significant boost to GDP growth, and that is likely to affect the US stock market quite significantly. I know that lots of people say that, yeah, but the US market has already peaked. The US market has been so strong last year that, you know, I'm struggling a little bit to buy into this market. What are my risks? And of course, there are risks, which I'll come back to in a second. But on this chart, you can see that since 1871, US equities have actually done very well in the year following the year when it hit a new all-time high. As you can see, and, all those years marked in green at the bottom of the chart are years that came immediately after the market peaked. And as you can see, markets on average have actually done very well. There's a significant skew to the right, so a skew to the upside. In other words, markets are more than likely to do well in years following a peak of the index as we saw in 2020. So back to things that you should worry a little bit about, because obviously it's not either black or white. It can go either way. And there are a few things that I'm concerned about here. Number one, the US market is admittedly expensive. There's no two ways about it. I cannot argue that it's dirt cheap. It is not. As you can see in this chart, on the top chart here, the US CAPE ratio, which stands for the cyclically adjusted price earnings ratio, is now near an all-time high since we started measuring this in 1881. Only during the dot-com boom around 2000, 2001 was the CAPE ratio higher than it is now. And normally when the CAPE ratio is in its 30s, as it is now, we are due a correction. So yes, it is definitely possible we'll get a correction, and that correction could be meaningful, but I still believe that when we come to the end of the year, we'll be up versus prices we have today. The other thing that I'm concerned about when it comes to the current expense levels of the US market is what you can see at the bottom chart of this page 10. The black line at the top here represents what Goldman Sachs called retail favorite stocks, stocks like Amazon, Tesla, Apple, Facebook, blah, blah, blah. You know, those kind of stocks that also, many of them go under the name big tech. But Goldman has found in its research that stocks that are favored by retail investors have vastly outperformed stocks that are favored by institutional investors. And again, more than vastly outperformed the S&P 500, as you can see on this index. This chart was produced in late November, but it happened that this morning I got a chart that was updated to yesterday. And as you can see in this chart, the party has continued for these stocks that are favored by retail investors. The Goldman Sachs Retail Favorites Index, as it's called, is now up 100% over the last 12 months, where the S&P 500 is not even up 20% yet. So yes, back in November when the chart I just showed you here on page 10, back then when it was produced, my retail favorites in general were quite expensive. Now, a few months later, retail favorites are even more expensive. And that does worry me a little bit in terms of a correction being overdue. But again, as I said, even if we get a correction, we should be okay in the long term. Biden's spending program and the war chest coming from the private sector should be more than enough to hold up the US market over the next 12 months. Second issue is inflation. As you can see on the right-hand side of chart 12 here, you can see that imported inflation is already up. Imported inflation has arrived as a result of a relatively weak US dollar. I happened to look at the US dollar versus South African rands the other day, and there can be no doubt that the South African rand has performed extraordinarily well against US dollars more recently. And the same is the case for lots of other emerging market currencies. And basically what is happening is that all the commodities that the US is importing from these countries are getting more expensive, hence higher imported inflation. On the right-hand side of this slide, you can see a very interesting index which is produced by Citibank, or Citi as they're just called these days. Citi has created an index they called Inflation Short Index, and another index they call the Inflation Long Index. And as you can see in this chart, the long index is vastly outperforming the short index. Let me explain. The short index is a compilation of lots of companies that would all be penalized if inflation goes up. The inflation long index, the pink index, is an index consisting of companies that will benefit from higher inflation. So what I'm saying with this chart is that not only do we expect inflation to go up a little bit, but we're not the only ones who expect inflation to go up a little bit. The Citi Inflation Long Index would not outperform the Citi Inflation Short Index as much as it has done the last few months if there was not a broad consensus in the market that inflation is likely to increase. And therefore, concern number two, yes, inflation could rise, but a significant part of that has already been discounted in prices. Finally, concern number three, this is really the impact on the taxpayer if Biden goes out and spends $1.9 trillion over the next few quarters. How would that affect the US income tax rate? As you can see in this slide, there can be no question that the tax rate will go up, and normally a higher tax rate is bad for the stock market. But as you can also see in this slide, it is not at all out of context with lots of other events of rising taxes over the last 70, 80 years. And given that it will have a significant positive impact on growth and on corporate earnings, I think the market can live with a somewhat higher tax rate. If it was in a league of its own, I would be far more concerned. But as you can see in this slide, it is not in a league of its own. It's actually relatively modest compared to other events of rising tax rates over the last 70 to 80 years. That completes my presentation. Back to you, Nanda. Any questions for me?
Thank you so much for that, Niels. That was comprehensive. I think that people will enjoy to go through the slides and think about this beginning of a new era. You have termed it, and not era. I hope that we will be learning from all of the experience of the years, which is what I picked up from your presentation, is that you've actually done a comparison over the years. Which is why you can speak to the impact now with the new president. So thank you very much.
What I haven't touched on, and I probably should have touched on, is the fact that the US nation as one nation is deeply split. You still have lots of people who are loyal to the old president, and you have the other camp, people who think that the old president was a bloody nightmare, and that Biden is the best thing that has happened to the US for a long, long time. And therefore, one of Biden's biggest jobs, probably the biggest job over the next many months, probably many years, would be to reunite the American nation, bring them back together, make them feel as one people again. The good news from an investment point of view is that these sort of things rarely impact the stock market. The stock market is far more concerned about economic events than they are about political events. And therefore, yes, it's an issue we should worry about, but it's not an issue that I would overly emphasize, because it's not going to have a massive impact on the stock market.
Great, that's clear. I really enjoyed this. You contextualized it all for us. Thank you so much. Thank you for your time.
You're welcome. Have a good day.